kind of the testing situation as we speak, and I'm guessing these kinds of tests will be with us for a long time.
Yes, the tests will keep evolving. Others will put the high accuracy tests on the market in miniature form like we're doing. But it's interesting, a lot of tests are out of stock when you go to your grocery store or pharmacy. The home kits are out of stock.
Tim and I are nodding big time for those on radio.
Preaching to the choir, my friend.
Absolutely. And then also at the same time, the FDA has started to make a list of tests that may not be so accurate for Omicron, and we're likely to see that in the future even more with additional mutations because tests may target the wrong area in Omicron now, an area that is mutated from Delta. So more and more concern about that.
Wait, what?
Yeah. Can those tests, like, okay, so let's say, some tests that are common, Binax now, for example, from Abbott Labs. Could a test like that be altered? Could a test like that be altered by Abbott to pick up different variants in a better way?
And how quickly?
Absolutely. Someone like Abbott could work that out very quickly, but then they'll have to go through the emergency use authorization procedure again. So realistically, you're talking about several months in most cases, which is light speed compared to years ago. But absolutely, Abbott could make that adjustment, and so could others, and others probably will have to do that in the future.
It's an interesting world. Tim and I were also talking about the cost of tests. I mean, they're not inexpensive, certainly the at-home tests. And
okay,
I do
but
want.
let's just be honest. You texted me. Carol texted me last night. Okay, at 9:36 p.m.
That's when I bought mine.
And she said, "I found some tests at this drugstore near the office. I went this morning and I picked up 4."
We have like and thank you, Creedy, because she's the one who's like, hey, you got to check out this pharmacy. So it's been like a little network inside of our offices. So we do find that. But I do worry about people who need to work, can't afford these tests, maybe are vaccinated, fingers crossed they are. I mean, we need to just get tests out. I think over in the UK, one of our colleagues said the National Health Services, just supplies them.
Yeah, and the same thing was done in Switzerland, where every family was given 5 tests per family member for each month. They could test regularly. And as a physician, one of the greatest challenges we had in the emergency department are low-income folks that are working. They can't afford the tests, and they also can't afford to stop working when they're sick or feeling sick. That means they infect others. It's a really difficult position to deal with.
So how does this pandemic end? We're entering year 3 of it, Doctor, and I'm just, this is a pretty exasperating time, I think, for a lot of people, especially those with young kids who are not in school as a result of this and are concerned because those kids can't be vaccinated yet. I'm speaking about myself. How does this end?
Sure. I think probably we learn to live with the virus and its different mutations. Hopefully we get more mutations like Omicron that don't make people quite as sick. Overall, the immunization or immunity in the community and the society goes up, and we have more very highly effective medications so that one day in the future, Omicron is a little bit more like the flu. There are susceptible people, they get extra immunizations. If you get the flu, we actually may have more effective medications against Omicron than the flu, and I think that'll absolutely be the case in the near future.
Dr. Blavis, just got about a minute or under a minute left here. What's the outlook in terms of, I know you guys are working on submitting your COVID test for FDA authorization under the Emergency Use Act. Any update on that?
Yes, we just started enrolling patients. We're hoping to be done enrolling patients by the middle of this month, maybe the 3rd week. And then if all goes as planned, we'll get the emergency use authorization by the FDA to start selling on approximately March 1st.
All right. Well, good to know, and we wish you good luck with it. Certainly, it seems like the world is just appreciative of the more tools that we have to deal with this. Dr. Michael Blavis, he's Chief Medical Officer at Anavasi Diagnostics, joining us once again on the phone from Atlanta.
Well, let's get a check of what exactly is going on when it comes to the trading day. Here with the market update is Charlie Pellet.
Hi, thank you very much, Tim Stanovic. Dramatic turnaround from what we were seeing yesterday. We've got NASDAQ now down 291 points. That is a drop of 1.8%. The NASDAQ 100 index is down 1.9%. Let me give you the numbers first. We'll give you the why in a moment here. The S&P slumping 10, down 0.2%. Dow Industrials holding on to a gain today of 244 points, another record there, up by 0.7%. A rout in tech shares dragging stocks from records on concerns higher interest rates will devalue their profits. Right now we've got the 10-year yield 1.66%. Spot gold up 0.8%, 18.14 the ounce. West Texas Intermediate crude up 1.3%, 77.05 a barrel. Lots of weakness in some of the biggest tech stocks. Apple, for example, down 1.3%. Alphabet, parent of Google, lower now by 0.6%. Amazon down 2.1%. And Meta Platforms, Inc., formerly known as Facebook, down now by 1.1%. Again, the 10-year yield, 1.66%. The Centers for Disease Control and Prevention is recommending that people get a booster shot with the Pfizer-BioNTech vaccine 5 months after their first 2 shots, shortening the interval from the previous 6-month regimen. Data continues to indicate Omicron is less likely to cause serious illness, particularly in vaccinated people, spurring optimism that tighter restrictions on traveling will be avoided, but even so, that is still not easing the burdens on hospitals. Dr. Amish Adalja is senior scholar at the Johns Hopkins Center for Health Security.
It is going to cause a lot of disruption in its wake because many people get infected, and we have to worry about hospitalizations, even if they're lower with Omicron, being at least of a magnitude big enough for some hospitals that are already kind of at capacity to get pushed over the edge.
Dr. Adalja with the Johns Hopkins Bloomberg School of Public Health, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks that we track on a regular basis at this time, all lower. Pfizer down 2.8%. Its German partner, BioNTech, its ADRs down 4.6%. AstraZeneca's ADRs down 1.7%. Moderna out of Cambridge down 1.4%. J&J Johnson & Johnson down 0.1%. Recapping, 10-year yield 1.66%, NASDAQ down 1.7%, S&P down 6, down 0.1%, and the Dow now higher by 0.7%. Fast-moving markets, keep it locked into Bloomberg Radio for the very latest. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Carol, you had a BlackBerry.
I did. I loved it.
How many years do you think you had it?
My Crackberry?
Yeah.
A few years.
Remember that.
I do remember it. And I didn't quite get it until I got one, and then I was like addicted.
And then as soon as the iPhone came along, what happened?
First, I didn't love it.
Yeah.
And then
you wanted that old keyboard back, right? You wanted that
loved-
physical keyboard.
Did you have one?
I did have a BlackBerry.
Did you like it?
Yeah, it was fine. I mean, but I went to iPhone pretty quickly
And you
after
can do
it came out.
so much more with a smartphone.
Yeah, you really can. It's a lot different, but it's certainly fair to say that it ushered in a new era when it came to smartphones and personal technology. Well, it's the end of the road for BlackBerry,
Rest in
at least
peace.
the BlackBerry operating system. We should know.
Good point.
We should note that you can still get BlackBerries that are powered by Android. Joining us now to talk all about it is John Butler, Senior Telecom Services and Equipment Analyst for Bloomberg Intelligence. He joins us on the phone from New Jersey. John, how many people is this going to affect? BlackBerries are they're like unicorns, right? You see them in the wild and you're like, wow, there's BlackBerry.
I was listening to you guys talk. I had a BlackBerry as well. I don't see a lot out in the wild anymore. I'm not sure it's really going to affect many people. And BlackBerry years ago.
My name is Carol, and I have a BlackBerry. It's like, you know what I mean? You wonder if people hide it, right, John?
There's a few of us out there, but I switched to the iPhone pretty quickly too. But it was one of those corporate libel phones. Like companies paid for your cell phone and gave you. In my case, I had a RIM pager. If you remember the old name, Research in Motion.
Yeah.
And you eventually moved to 2 phones, and people loved BlackBerry so much that they ended up hanging on to the BlackBerries for a long time. And honestly, 3 or 4 years ago, I used to see a lot of BlackBerries out in the wild, so to speak, and I'm just not seeing them anymore. So, Carol, to answer your question, I don't think there's a lot of users at this point that are still hanging on. But, from a corporate standpoint, it's something that BlackBerry needed to move on from that. They really are a software maker right now. They'd moved into mobile software and security software, and they sold off that handset business years ago.
No.
So
it's a good point, right? They've been going through changes, John. So I don't know, how do you see the outlook or the future of BlackBerry?
So they are still a company in transition, and I think a lot of people would have thought at this point they would be out of the transition and growing better, and they still have to make some moves. So speaking of handsets, they had this huge portfolio of intellectual property for wireless, and they're trying to sell that right now to fund R&D to get a bunch of new products over the finish line. And we're almost there. You know, it's one of those stories you can see it beginning to come together, but they need more funding and they need a little bit more focus. And, you know, my sense with them is I think they'll get there. It's hardly a given, but I think they're on their way. I think it was high time that they finally kind of let go of that wireless business. Even a couple of quarters ago, they were still reporting what they called service access fees. So people who had a BlackBerry would pay a fee to get access to their proprietary network for email and file transfer and that kind of stuff.
Hey, John.
And so that'll go, and it'll free up some cost, I think.
Hey, John, I wonder if there's any sort of lesson in here about business cycles and companies staying on top of things that we can learn from the rise and fall of BlackBerry, especially the day that after Apple hits $3 trillion in market cap. Because if we think back to 2007 when Steve Jobs stood on that stage and introduced the iPhone, there were a lot of people out there who said, there is no future for this thing. BlackBerry dominates when it comes to smartphones.
You know, I think the lesson learned is, particularly in the tech industry, some of these gigantic companies can literally disappear. And or they can disappear from a given business, as was the case with BlackBerry, but they really are a shadow of their former self, if you will. But LG just left the smartphone business, and they were a pretty big player for many years. And so, to me, I always use BlackBerry as an example of how these tech behemoths can really fall from grace and ultimately disappear over time. And I think the other lesson, and I've learned this over the years as an analyst, is that it's important to have the right CEO in place at the right time in a company's life cycle. And I think Apple is a great example of that. I think Tim Cook came in right at a time when Apple had reinvented, their product line was set, but they needed a logistics guy to really grow it to where it is today.
Yeah, exactly.
And Tim Cook, I think, was the right guy to do that.
All right, John, hey, we got to run. Thank you so much. Always appreciate your insight. John Butler, Senior Telecom Service and Equipment Analyst at Bloomberg Intelligence.
Well, let's head to Washington, D.C. for a check the latest world and national news. Nancy Lyons, did you have a BlackBerry?
I did not have a BlackBerry, but my husband did at one point.
Okay.
Yeah, I did not. Okay. But I know so many people who are sad to see it go.
So true.
Anyway, President Biden says the Omicron variant of the coronavirus is surging, and he's urging those 35 million Americans who remain unvaccinated to finally get their shot.
You'll experience severe illness in many cases if you get COVID-19, if you're not vaccinated. Some will die, needlessly die. Unvaccinated are taking up hospital beds and crowding emergency rooms and intensive care units. That's displacing other people who need access to those hospitals.
Biden says he knows the testing situation is frustrating. He says his administration is making improvements. He's warning that the next several weeks are going to be challenging as cases rise. He does call the new antiviral pill a game changer and says he's pushing the manufacturers to make more of those pills and quickly. The travel nightmare continues in Virginia, where a 50-mile stretch of Interstate 95 has been closed in both directions since yesterday. Justin Beal says he's been stranded for over 17 hours.
So we've been, streaming Netflix, eating food, and just trying to pass the time by and, making friends with the people that we're stuck with here on 95. It's been an adventure, to say the very least.
Beal says he's hoping help is on the way because he's seen elderly and others in need stranded in their cars. Airline cancellations has spilled into a second day because of that storm. Some 21% of flights at Baltimore Washington International Thurgood Marshall Airport were grounded earlier today, according to FlightAware.com. Global news 24 hours a day. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic, right here in our Interactive Brokers studio on Bloomberg Business Week. So, we talked a lot yesterday about the first trading day of the new year and everybody kind of weighing in on what they think is to come for the markets. JP Morgan out with some details.
Yeah, JP Morgan's actually saying that the global stock market party is far from over.
Still
So,
keep the
I was
champagne
making the joke
out.
a lot last week. Should we be partying like it's 1999? That was, of course, just a few months before
Were
the...
there people around you that were like, what?
Yeah, everyone was like, what are you talking about, Tim? We don't understand what you're saying. And I'm saying, well, maybe it wasn't funny. So that was my problem.
Funny.
But it's interesting because we're learning more about what analysts are saying. And, there were a lot of analysts who said after 3 years of consecutive double-digit growth for the S&P 500, your expectations shouldn't be that high. But here's what JP Morgan strategists are saying, quote, stay bullish, positive catalysts are not exhausted. Those downside risks, hawkish turn by central banks, a slowdown in China's economy, more significant coronavirus restrictions, those are going to either fail to materialize or are already priced into stocks, they said.
This is the problem, right? We don't know. What happens if, virus gone in 3 months, 2 months, 1 month? Would you travel more?
Yeah.
I would travel more.
Absolutely.
Probably eat out more.
Mm-hmm.
And maybe.
So how would your spending shift?
How would it shift?
Does that mean that we can order couches again and get them? Seriously.
But
if you're spending more at
Right.
restaurants, if you're traveling more, you're not going to buy that couch.
And how much spending is not happening on money or borrowed money or leveraged money? You know what I mean? That would happen, and what would be the economic impact?
Okay, so I guess
Is it just not just a shift, but also maybe magnified?
Well, that's
multiplied?
the question, right? If it's not necessarily a shift, if people, because what we saw over the last year and a half is that people shifted their spending. So especially now, and so they're still spending that money. It's just going, to
Elsewhere.
goods rather than services.
But how much is not happening? And still, lots of questions. But JP Morgan sees it pretty optimistically. It's something we'll continue to talk about, and we know the Fed will continue to talk about it, and every guest that we have on will continue to talk about. You're listening to Bloomberg Radio.
facts, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet-Roth. Session lows in the S&P 500 index now down 5 points, drop there of 0.1%, but we're seeing a rout in tech shares. Stocks declining from records on worries higher interest rates will devalue their profits. Right now, the 10-year yield 1.66%. NASDAQ down 257 points, a drop of 1.6%. The NASDAQ 100 index down 1.7%. The Dow holding on to a gain of 257 points, up right now by 0.7%. The Dow at a record. Again, the 10-year down 11/32 with a yield of 1.66%. Spot gold up 0.7%, $18.14 the ounce, and West Texas Intermediate crude up 1.2%, $76.98 a barrel on West Texas Intermediate crude. American Express is postponing its return to U.S. offices amid a surge in COVID-19 cases, a link to the highly contagious Omicron variant. The New York-based credit card giant says it will give employees 2 weeks' notice before it starts bringing a larger number of staffers back to its offices. Again, recapping, stocks are trading mixed. The S&P down 6, a drop of 0.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, obesity is a disease, and there are ways to fight it, including prescription drugs that work. The problem is most doctors are not prescribing them, and insurers won't cover them. Let's get to the reasons why.
Well, Emma Cord is healthcare reporter for Bloomberg News. She joins us on the phone from New York City. Her story is going to be featured in the upcoming issue of Bloomberg Businessweek magazine. You can read it now, though, on the Bloomberg terminal and also online at bloomberg.com/businessweek. Joel Weber is editor at Bloomberg Businessweek. He joins us now on the Access line from Brooklyn. Joel, Carol mentioned this group of drugs. This group is known as GLP-1 receptor agonists, or GLP-1s. What do they do?
It's very catchy, right?
Yeah, it is. For the pharmaceutical industry, really has a way with naming things, right?
Yeah, exactly. But, regardless of name, the science behind these shows promise. And as Emma goes into in the story, the drugs and this class of drugs is really geared maybe not at just, those stubborn 5 pounds that we'd all like to get off, but at a whole category of people who really haven't had that many drugs for them before, which is obese people. And obesity being such an epidemic in the country, numbers that are stubborn and really don't go down. And yet, doctors have this stigma around it. It's like, it's still in their mind can be a behavioral problem that science can't necessarily solve. Insurance, on top of that, looks at this new class of drug, and they're not necessarily throwing money at it, all of which, kind of leaves this solution to a big problem, somewhat on the shelf. But now I'm talking out of turn, and I want to hear more from Emma. So, Emma, how did this story come into being, and what kind of potential does this class of drugs really have?
Hi. Well, thanks so much for having me on, and I hope everyone who's listening has a chance to check out the story. The piece started, there were a couple of early threads, but I started hearing about some startups that were trying to treat obesity and help people with weight loss using medication and telemedicine, so these like virtual doctor's visits, and I thought it was sort of an interesting approach, and at the same time was hearing about pharmaceutical companies trying to develop better obesity drugs. And, as I learned more about the space, I just kept coming back to this point of even previous to these GLP-1 drugs that are starting to be developed for weight loss and obesity specifically, they would previously been used in diabetes. There have been prescription drugs that can help people lose weight that are rarely used. And this is going back several years, and there's a lot of different complicated reasons for that, but I kept kind of just being struck by this discrepancy between the fact that, many people are obese or overweight in the U.S., hundreds of millions of people, and yet people are consistently being told to diet, to exercise, and they're not being told about this other option that's available for them.
All right, Emma, the thing I find like crazy, like blows my mind a little bit is, and you write this, the biggest constraint on weight loss drugs remains buy-in from the broader medical industry. How can doctors who potentially see this as something that could really, like prescribing one of these drugs, help one of their obese patients? How are they allowed, as a doctor, not to prescribe it?
That's a really good question, Carol. And I think, I quote a doctor, an obesity doctor in the story who says sort of, if you treated diabetes or hypertension in this way, like, a doctor would lose their medical license. I mean, it's kind of remarkable that, we're very comfortable prescribing, and by we, I mean doctors prescribing medications for so many different kinds of medical conditions. And I think a lot of this has to do with the way obesity has previously been seen, right? People think of obesity or being overweight as really being something that you kind of did to yourself, right? And we kind of get into this more in the piece, but you didn't work hard enough to lose weight, right? This is your fault. As a result, this is treated as a lifestyle condition. You're eating too much, you're not active enough. There's some more complicated science that's come out in the last several decades that shows that our bodies really do have a big influence over how we, when we stop eating, when we're hungry, when we feel satisfied after we eat, and that there's more biologically going on than merely sort of, refraining from getting on the treadmill every day, which is what I think a lot of people unfortunately still think, and even doctors and certainly people who struggle with their weight themselves.
Well, I'm just gonna make one comment because I know Tim has a question, but I wrote a note. Being obese is big business, and it supports a lot that's out there. Anyway, that's my opinion piece there.
It does, and it's a good thing for us to be thinking about in the new year when a lot of people have different fitness goals and weight loss goals that are associated with the new year. I want to talk a little bit more about that, Emma, and obesity, because I'm always shocked to see these statistics about how many Americans are obese or overweight. 3 in 4, an estimated 245 million people. Can you talk a little bit though about comorbidities here and the dangers of being overweight? They've come to the surface a lot in discussions of COVID, but beyond that.
Yeah. So the big kind of concern about having excess weight is obviously that's defined by the body mass index standard, right? So people who are obese are at higher risk of developing various medical conditions, including diabetes. Another risk that's tied to obesity is actually all-cause mortality, so literally death by any cause. So we know from some of these statistical analyses that when you carry around extra weight, you are more likely to develop some of these other medical problems, and it does raise a lot of concerns for doctors and medical providers about your health, right? Are you as healthy as you could be? And as a result, it's led to a lot of interest in finding ways to keep pounds off, obviously not just for reasons of appearance, but also really health reasons.
So to wrap here, Emma, let's talk briefly about the science. How does this class of drugs that we're talking about here, the GLP-1s, how do they work?
And Emma just got about 30 seconds.
So they do a couple of different things, especially when you're talking about diabetes. They actually help the pancreas, get the pancreas to produce insulin to bring your blood sugar levels down. But when you're talking about weight loss specifically, what's really interesting about these drugs is they mimic a hormone called GLP-1, right? These drugs are named after them. And it actually kind of helps tell your brain, like, you're satisfied, you don't have to eat anymore. And that's kind of the key to it. It's funny, people might think of their gut hormones, but they actually work most potently, it seems, in the brain, which is kind of a fascinating thing to think about, this being really neuroscience at the end of the day.
All right, we're going to leave it on that note. Listen, guys, thank you so much. It's a really wonderful story. I mean, troubling story, but you should definitely check it out with all its details. You can find it at Bloomberg.com. Emma Court there and Jill Weber. This is Bloomberg.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close with 60 minutes left in the trading session. Caroline Hyde, Romaine Bostic, Taylor Riggs, joined now by our colleagues Carol Masser and Tim Stenovic. We together welcome our full Bloomberg audiences. We go cross-platform, TV, radio, YouTube, you name it. And we look at what is a falling from records kind of a day. Big tech, small tech in focus as we see those yields continue to climb.
Yeah, exactly. It really is a treasury bond market story. And I feel like the treasury trade is already saying we're done with 2022. I mean, it's pretty dramatic. And I feel like, I don't know whether I heard Taylor talking at one point or other folks on Bloomberg TV, but just should we start to be thinking about a 2% on that 10-year note at some point?
Yeah, and look at how this is playing out in the NASDAQ 100. Of course, the big tech companies, Tesla down 4%, Microsoft, NVIDIA, Amazon, Apple, all leading to the decline of 1.6.
I mean, volumes up some 23% on the NASDAQ, but the overall movement down by 1.5%. I'm looking at 247 points being lost when you're looking at the NASDAQ overall. You mentioned those big cap tech names dragging it lower. We also see, therefore, the S&P 500 cannot fight higher when you do have these big tech names under so much selling pressure. Only down by some 4 points, 3.7 points. We're at 4,792 as we trade, so basically flat on the day. But we are still seeing money move into some of the cyclicals. Dow Jones but gets a lift higher, 255 points higher, 0.7% higher. But the Russell 2000 also some selling going on today, Taylor.
And it's a cyclical and it's a value story. I know 2 days does not a trend make, but the story of the year is the story of today as well. With energy financials, the big outperformers, at least on a sector basis, on an intraday level. Energy just continuing to post big gains of about 3.7%. Financials, of course, benefiting from that steeper yield curve. Industrials, materials, you name it, some of the other big performers. But Romaine, you go to the bottom, and unfortunately, it is technology that is the worst performer, down about 1.4%. And that really is where some of these big tech companies are coming back into focus as those long duration assets.
Yeah, and I think we got to put this in perspective. I mean, we're going to talk about, obviously, the big cap tech names. Yeah, Apple is sliding a little bit here, and you have some other companies out there in that space like Microsoft and Tesla baked into that rise in rates. The idea here that you're getting a slower economic environment, the idea that you're getting a more inflationary economic environment, and it turns a lot of those multiples on its head.
Yeah, that is why you see a Robinhood off by 6%, why you see a Beyond Meat off by 5.5%, why you, of course, factor in that all-important yield curve, as you say, steepening. Check it out, the 2s, the 10s, currently really, it's a dramatic spike higher that we've seen in the last couple of days. Romaine, you're going to jump in.
Yeah, I was just going to give Tim a pop quiz here.
Oh, no.
Tim, which company in the S&P 500 and the NASDAQ 100 has the highest price-to-earnings ratio?
Oh, I don't even know.
Illumina.
What is it?
Illumina.
Oh, yeah, I wouldn't have gotten that right. Hey, Doctor, here's what I know. Dr. Scott Gottlieb's on the board. There we go.
Okay, I did not know that.
Okay,
you
pop
give
quiz.
me a pop quiz. I was giving pop quizzes to Tim all last week.
That's what you guys missed.
Oh, my God.
Yeah,
so glad I was
you know what's great? I would go home and then my dad would call me and he'd give me the same pop quiz and I'd get it wrong again. Thanks, Dad.
That's why you love families.
Yeah, exactly.
Well, listen, what's going on is some market rotation. We're definitely seeing that play out today. But so much is still, forgive me, but it's all about COVID. And Stephanie Kelton was on Bloomberg TV with David Weston earlier, also on Bloomberg Radio. She is an economist. She follows public policy, and she's been following what's going on in the economy. She's pretty optimistic, but she is concerned about the supply-demand imbalances. Here's what she had to say.
The supply side has revealed a lot of vulnerabilities, and we've seen it at the ports, and we've seen it with freight and trucking and all the rest of it. And so the supply side, I think, overwhelms the demand side contributors to the inflationary pressure that we're currently dealing with.
And so much, of course, that's Stephanie Kelton there from Stony Brook. But it's, so much of what happens, right, in the coming months is if we get beyond COVID, perhaps, Tim and I were just talking about this off air. What happens if in a month we're in a much better space? Are we all traveling? Are we spending more money? What does that do to the economy?
Yeah, how does our spending shift? And does it even matter if our spending shifts and we're still seeing some port congestion and we're still seeing some factories in Asia close because of a handful of COVID cases? That has serious repercussions that can hit, weeks, months later.
I am curious. I mean, we talk about, of course, what the potential dampening effect on economic activity is because of COVID. But then you look back into 2020 and into 2021, we saw more of a shift in spending rather than a complete sort of tamp down in the economy. That doesn't mean certain areas of the economy, certain industries aren't going to be hit hard by this, but there still seem to be some resiliency, and not only consumer spending but also business spending as well.
But talk about the here and the now and the headlines we get. Macy's, according to CNBC, cutting store hours temporarily as COVID cases spike. FedEx Express suspending U.S. on-call pickups from January the 4th. We're looking at Amex pushing back on the 24th of January. They were looking to release that Amex Flex, but they don't want to bring their colleagues back. And of course, that's way out and several weeks out. So this still speaks to companies that are trying to navigate this and finding difficulty, particularly from a labor perspective.
Let's talk about that labor perspective and that JOLTS data this morning with quit rates again at a record high 3% or 4.5 million. And some of the job openings, Carol, at least coming down a little bit, but over 10 million. I mean, so elevated, particularly when it comes to those pre-pandemic levels.
People are quitting and they're also finding new jobs. And that's what we're seeing. We continue to see them moving into new positions. I do think we should mention, though, ISM Manufacturing. I know we had it up for our TV team.
Yeah.
I mean, the gauge did fall, but there was some underlying support. Delivery times are being reduced. The prices for raw materials, that's coming down. That's a positive, guys.
Well, I mean, can we just go back to the quits data here? Because not all of those people went out and got new jobs. I mean, they're gone.
Right.
And when you looked at some of the industries that they were in, it really makes you wonder what's going on there. This isn't like just the great resignation, like, oh, I'm going to move on and, start a new business. These are people that have, my interpretation, if I could will, that seem to just be dropping out.
Well, it does remain to be seen what the definition of full employment looks like on the other side of this pandemic, who permanently dropped out of the labor force. But Romaine, it reminds me of our conversation that we had with the CEO of Dave's Hot Chicken last week, who said $15 an hour was the minimum wage that they were hiring. And he was seeing
something like $20.
Exactly, at competitors who were advertising, starting salaries of $20 an hour. And how does that filter into the higher costs that consumers then pay? And then we get back to the I word, inflation.
But you go back to the JOLTS data here. I mean, you talk about the industries that were hit hardest. It wasn't just about pay. It was also about the conditions that they were working under. It was a lot of healthcare workers, a lot of services workers. And again, this goes beyond just pay. People have just reevaluated their lives and maybe decided it wasn't worth it at any price.
Yeah, tough time for parents right now, Second day in a row, my kids' nursery school is closed. I'm not the only one who's, struggling to find daycare, but it can be difficult to find childcare. And, are you going to get back into the labor force if it's too difficult?
Take this outside and finish. No, we're going to finish
Everyone
this
knows what I'm
conversation.
saying here.
No, it's an important conversation, and we do wonder what labor participation looks like on the other side of it. Is it a whole different number? All right, folks, that's going to do it for now. We'll be back together live on TV, radio, and YouTube at 4 p.m. for our Beyond the Bell coverage. We'll take you through today's market close.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, you are listening to Bloomberg Business Week. Carol Masser along with Tim Stenovic. And, I think all I'm going to say is lots of questions out there. And, we'll see whether we start to get some clarity. We'll get FOMC minutes tomorrow. We'll get a better idea of what
That was like, a different era. Don't you think?
What, the last
Pre-Omicron?
Fed
I mean,
meeting?
not pre-Omicron, but it was like definitely before employers, before the change in guidance around quarantine, before we saw absolute mayhem over the last week play out when it came to airlines and travel. So much has happened.
Well, on airlines,
because of disruption.
And we see airlines up today.
Yeah.
We saw that, in the UK, a bunch of travel stocks like moving up. I think Marriott was one of the outperformers in the S&P 500 because some of the guidance we're getting on Omicron is saying it's not going to be as long lasting. It's, but we won't know until we get through the next few weeks.
Okay, but if offices in New York City are empty, what does that mean for the subway? What does it mean for people spending or lack thereof
it is
on
lost
lunch
economic
when they
activity
go there
for this period?
And I'm not just talking about New York here. I'm talking about offices in areas around the country.
Right. Yeah. I don't know. If I knew, I would probably be on my home in Grilla. I'm just going to say. But we have a lot of economic news, including the jobless report. We'll get a Fed meeting. We'll start to hear from CEOs in terms of earnings, and maybe it'll give us a better indication of what's to come. But safe to say, it feels like things have changed for the long term.
All right, let's go check the latest world and national news. Nancy Lyons is standing by in Washington, D.C. with that. Hey, Nance.
Thanks, Tim. President Biden is again urging the 35 million Americans who remain unvaccinated to get their shot now as the Omicron variant is taking hold.
We have in hand all the vaccines we need to get every American fully vaccinated, including the booster shot. So there's no excuse. No excuse for anyone being unvaccinated.
Speaking at the White House, Biden says COVID vaccinations work and help protect Americans from the worst effects from the Omicron variant. Democrats are back to talking about a voting rights bill. Senate Majority Leader Chuck Schumer says if Republican lawmakers continue to block consideration, then Democrats will pose a change to the Senate rules that would allow them to pass it without GOP support. But Democratic Senator Joe Manchin of West Virginia says any changes to the rules could cause an imbalance in the Senate.
I've always been for rules being done the way we've always done, 2/3 of the members voting. And any way you can do a rules change to where everyone's involved, and basically that's a rule that usually will stay.
Manchin says he's keeping an open mind and still having conversations about the options. With January 6th almost here, Capitol Hill Police Chief Tom Manger says they're ready if anything happens to mark the anniversary.
We're aware of several events that are planned for Thursday. Most of them aren't of much concern to us. There's no intelligence that indicates that there would be any problems.
Manger says they've improved their intelligence and operational planning to prevent another riot. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. You're listening to Bloomberg Business Week. Carol Master along with Tim Stanovic. Hey, so one story, we talked about this yesterday. We actually talked with our Todd Shields, who covers the FCC and the regulatory environment, about AT&T and Verizon, and we talked about 5G and the concerns among the airline industry.
Yeah, so an update on that. Biden hails 5G delay from Verizon and AT&T in this aviation dispute. President Joe Biden hailed an accord with AT&T and Verizon. They've now delayed by 2 weeks this new 5G service so that airlines and safety officials can take steps to prevent interference with aircraft electronics. What Todd explained to us yesterday, Carol, for those who weren't listening, is that there's concern from airlines that the deployment of this new of 5G on this new spectrum could interfere with altimeters on airplanes and cause confusion for pilots on how high up they are from the ground. Obviously a safety issue.
Right, exactly. For taking off, for landing in particular.
And that's what the airlines are saying.
Exactly. So we're having this debate go back and forth. The FAA had been planning to issue hundreds of notices with specific restrictions for airport runways, heliports, and other flight routes, which it said could cause significant disruptions to the aviation system. So the delay, I guess they're going to look at it, right? And we certainly want to make sure that there is safety, especially in congested cities.
What can they get done in 2 weeks that they weren't able to get done up till now?
It's a good point. Like, to me, it's like, why didn't you have this done a long time ago when we were auctioning off? And I don't know.
When was last, Carol, before we talked with Todd yesterday, we talked about this story months ago.
Right, exactly.
This was on the radar, they did it again, of a lot of people.
Yeah, exactly. No. Nicely done. So we'll see what happens. And, the airlines have certainly threatened some litigation. And there's been petitions sent to the White House. And certainly Pete Buttigieg is looking into it, the transportation secretary. So he has requested, that they make these delays. And AT&T said it also committed to pause near airports. So they're going to hold off. But it's a good point. Like, what are they going to do in 2 weeks?
To be continued.
Yeah, exactly. We'll have more on this. You're listening to Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We begin with a developing story out of San Francisco. Wells Fargo's Chief Risk Officer Amanda Norton, who joined in 2018 to help turn around the scandal-ravaged lender, is leaving as the cleanup continues. She will retire from the bank at the end of June, and a replacement will be named in coming weeks. Wells Fargo shares, they're pushing higher now, up by 205, 52.78 on shares of WFC. Now, let's take a look at some of the other top stories. Let's head right over to the First Word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks trading mixed right now, with tech really under pressure. Dow's currently higher by 267 points. S&Ps are a little changed, while the NASDAQ, although off session lows, is still down 210. The U.S. 10-year yield at 1.66%. Gold is higher by 13. Oil is also up, and Bitcoin is little changed. Among the main 11 S&P sectors, leaders were energy and the financials. Tech and healthcare were under pressure. And leaders to the upside in the Dow, Caterpillar, JP Morgan, and Goldman Sachs, while Salesforce and Cisco led to the downside. In other news, Charlie Munger's Daily Journal nearly doubled its stake in Alibaba. Macy's cut store hours temporarily as COVID cases spike, and NVIDIA announced new GPU chips for laptops. Wrapping things up, Ford gained as much as 13%, while General Motors hit a record high. Live from the First Word breaking news desk, I'm Bill Maloney. Charlie.
Okay, thank you, Bill. You've got us covered, and to hear live breaking news over at your Bloomberg, type Squawk, SQUAWK, on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. Later this month, we're going to get an update on Netflix when it reports its latest quarterly results. This is the company's edging closer to investment-grade status. It's what you call a rising star, at least according to our Bloomberg intelligence team. That is about the upgrade to their investment grade status.
Let's get into it with Olivia Raymonde, credit markets and high yield bond reporter for Bloomberg News. She joins us on the phone from here in New York City. Olivia, great to have you with us. Can you help us make the connection here between what exactly is going on with Netflix right now on the credit side, and what we've seen with Netflix's stock in recent years as it's continued to just fly higher?
Yeah, so thank you so much for having me on. So Netflix is poised to become a so-called rising star at some point this year, and what that means for listeners who aren't aware of that phrase, that just simply means that a junk-rated company is moved into investment-grade status, and all of its debt gets moved into investment-grade indices. So Netflix already has one high-grade rating from S&P. They upgraded Netflix last October. So all it needs is a second high-grade rating from one of the major rating agencies for it to bump up to that rising star status.
So tell us about what that means, because that means basically what? Servicing your debt costs less.
Yeah, exactly. So when companies leave junk status and become investment grade, they can get finance from a deeper pool of borrowers at lower rates.
So what are the changes that the company's made in order to boost its credit rating? How has this happened?
Yeah, so their credit metrics have performed and have been improving. They have raised an ample amount of liquidity, and they've also signaled that they are not going to need to take out much more debt in the future due to the recent successes that they've had, especially over the pandemic when everyone was stuck at home watching movies and shows on the streaming service, and boost its viewers. So that's helped it shore up some money and need to tap the bond market less frequently.
Well, okay, so just help me out here, because I don't cover the credit market closely at all. So, I really focus, I look to a lot of the equity performance. And here so far, in 2021, Netflix was underperformed the NASDAQ, but finished higher by 11%. It was higher by 67% in 2020. It was higher by 20% in 2019, 40% in 2018, 55% in 2017.
You're talking to the credit market person about the equity?
Yeah, because what I'm saying is the rating for the credit rating hasn't really dissuaded equity investors here.
So have they been stupid?
That's what I'm. Thank you, Carol.
No. What we're seeing
Or smart?
is,
Did they have foresight?
Yeah, what we're seeing is investor foresight here. They're anticipating that Netflix fundamentals will continue to improve, and that's reflected in the credit rating analysis that the major graders send out as well.
It's like fair to say it's like a lagging indicator.
Yeah, right. Which one? The equity market?
The credit market.
Or the credit market.
Yeah.
But isn't the credit market often, well, so tell us about, right, we spend so much time, as you know, Olivia, talking about the equity side of things, but the credit markets, can often tell you very quickly if a company's in trouble. So I'm just thinking about for our audience who watch both things, but again, we talk so much about the equity side of things. What does this potential upgrade also mean in terms of how investors overall look at this company, or maybe should look at this company, especially when you dig deeper into that balance sheet?
Yeah, for sure. The important thing there is that what happens often is when a company is upgraded to investment grade, they issue bonds very shortly after because they can get them at a lower yield. And so therefore they tend to trade better than the broader market. So according to Bank of America strategists, and this is a quote, rising stars should be bought as soon as possible. And that's not just for Netflix, but for the potential $169 billion wave of rising stars that we could see this year after we had a very large credit rating downgrade during 2020 amid the worst of the pandemic.
Hey, just quickly, and if I think about on the equity side thing, we talk so much about indexing, right? Or people who are invested in index funds. Same thing though, if the credit is upgraded, right? You're more likely to be in a lot more corporate indexing funds or index funds.
So that's exactly what happens. Once your company is moved to investment grade status, your debt leaves all high yield indices and it's moved into investment grade indices.
All right. Makes sense. Good reason to keep an eye on Netflix, and always important to look at the credit side of things. Olivia, thank you so much. Olivia Raymond-Day, she's credit markets and high yield bond reporter on the phone in New York City. You can't say you're not a credit person.
I'll admit it.
You look at all this stuff.
We do, but Rising Star, that works pretty well for Netflix.
It's a better trend than maybe
It does. It works so well for Netflix. It's a show it's a company that is focused on stars, whether, that's Squid Game or what was that movie, Power of the Dog, Carol?
Yeah.
You liked?
Yeah. Tim recommended it. I'm sorry.
I liked it.
I lost. It was lost on me. All right, folks, stick around. Chart of the day coming up.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you're listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. We've got the chart of the day coming up.
Yeah, Kriti Gupta from Bloomberg Markets is going to be joining us. We're talking a little bit about oil and OPEC Plus.
Yeah, there's been some developments, so we'll get to that in just a moment. Right now, though, let's get to that trading day and over to Charlie Pellet. Charlie, 29 minutes to go.
Indeed, and here's what's going on. We've got a route underway, a tech route. You got to keep it locked into Bloomberg Business Week to see how things shake out and, of course, how Asian markets react tonight. Daybreak Asia will have you covered on that. But here's where we stand right now. Right to the numbers. We'll give you the why in a moment. NASDAQ now down 207, down 1.3%. The S&P higher, barely, up by 1 point. Little change. We've got the Dow up 269, up by 0.7%. The NASDAQ 100 index, full of tech names, down now by 1.3%. 10-year yield, watching that, 1.65% on the 10-year. Gold down up 0.7%, 18.13 the ounce. West Texas Intermediate crude up 1.3%. 77.05 a barrel. A rout in tech shares dragging stocks from records on concerns higher rates will devalue their profits. Data continues to indicate Omicron is less likely to cause serious illness, particularly in vaccinated people. Dr. Amish Adalja, senior scholar at the Johns Hopkins Center for Health Security.
So it's probably about half of what Delta was in terms of its ability to hospitalize and kill, based on what we're seeing from other countries. But it still is likely a little bit higher than influenza. And you have to also take into account the transmissibility. Because Omicron is much more transmissible, even if it has a lower case fatality ratio, if it infects more people quickly, that could still end up being a wash in the end, that the same amount of people get infected because the attack rate is so much higher.
Dr. Adalja with the Johns Hopkins Center for Health Security, which is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Checking some of the vaccine stocks that we track on a regular basis. Pfizer down by 3.4%. Its German partner BioNTech, the ADR is down 3.5%. AstraZeneca's ADR is down 1.6%. Moderna down now by 0.7%. Walmart and Kroger are boosting the price of a popular at-home COVID-19 test after a deal with the White House to sell the kits at cost expired. The price of the Binex Now test at Walmart rising to $19.88 this week from $14. Kroger has said it reinstated, quote, retail pricing. Recapping, S&P lower by 1.2%. The S&P higher, I should say, by 0.1%. It is NASDAQ down now by 1.2%. The Dow up by 0.7%. And that's a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Well, it's time now for our chart of the day. Let's bring in Kriti Gupta, Bloomberg Markets correspondent here at Bloomberg News. She joins us once again on the phone from our headquarters here in New York City. Kriti, your chart today focuses on oil and specifically on OPEC Plus because a lot of oil-consuming nations, they've been pushing OPEC Plus to raise output as energy costs have gone up. But your chart focuses on something that's kind of different in terms of the way that we thought about the last two recessions and how fast OPEC Plus is increasing output.
Yeah, what's really interesting is first today we had an OPEC meeting, and they once again raised their output by 400,000 barrels. And this comes as we kind of heard from the Biden administration, from China, that OPEC really needs to kind of increase their output even faster so that oil prices are cheaper, so that the average American doesn't have to pay that much at the gas pump, or the average European, for that matter, doesn't have to pay that much when it comes to their electricity bills or their natural gas prices, essentially, to heat their homes. That's going to be a major problem that's going on in Europe right now. So my chart just kind of puts that into perspective a little bit. It takes a look at OPEC output going back to 2000 and really shows how long did it take for OPEC to get some of that supply back online in the face of a recession. So after 2000, OPEC took about 3 years to kind of recover all their output. After 2008 and that big kind of recession, it took them 7 years to recover all of it. And right now, they're on pace to recover their output in just 2 years. So compare that to some of the criticism that they're actually getting from the Biden administration or from some of these other oil-consuming nations, and they're actually going at a very fast rate than is historically normal. And this, of course, comes as they start to have oil prices that meet some of their fiscal requirements. For example, Saudi Arabia has a break-even rate of $78 a barrel, which means that their country as a whole, their fiscal budget, is actually in the positive as opposed to a negative. And right now we're at $80 on Brent crude. So it's actually good news for Saudi Arabia, for Russia, and the like.
So is this basically, hey, everybody who's complaining about what OPEC is doing, stop it, because they're coming back? Like, what's the takeaway here? And, you know, I ask this a lot when we do a story, or especially when we're looking at a market trend. Why should our audience care?
Well, our audience should care because, to your point, Carol, this is kind of like putting things into perspective a little bit. We do know that oil prices are rising. We know that the Federal Reserve and other central banks around the world are targeting their inflation policy, their rates policy, to kind of target inflation, a lot of which is driven by the energy prices. And one of the major things that the Biden administration in particular and other nations around the world have said is, well, we won't have to fight inflation if oil prices just drop back down, if they're kind of come back down to earth. And the people who control that is OPEC at its core. So in a way, yes, Carol, I am kind of saying that this chart shows that OPEC, well, they are actually doing their part. They're kind of raising output as fast as they can while still maintaining their own budgets.
All right, so when do energy prices go down?
See,
I know it's the chart of the day.
Now, if Creedy knows, then she too would be joining me on my island or my
She would have
home
her own island.
in Anguilla. You would have your own island.
Yeah.
Exactly.
I would be a much richer person than I am right now, that's for sure. Well, that's going to be the concern, right? I mean, if you have Wall Street forecasts or Wall Street strategists saying, well, oil prices could hit $100 a barrel, even in the face of a stronger dollar, that's usually an inverse. When you see a stronger dollar, oil prices fall. And right now you're seeing oil prices climb and the dollar climb, which tells you that there is this underlying demand for oil. Think about this, the travel recovery, people heating their homes when it comes to more corporate investment from a lot of big companies.
Right.
But put that into perspective with Omicron or, say, Iran nuclear negotiations, it's a completely different story.
Hey, Creedy, just in the last minute we have with you, you mentioned, oil climbing, but something else that's climbing today is shares of Ford, which are up by more than 12%. Take us into the reason why.
Yeah, well, very quickly, they're doubling their capacity for their F-150 truck, and this is going to be crucial when it comes to Ford kind of starting to compete with Tesla, with GM, and so this is a really big move. I'm going to spin it forward to tomorrow, though, because GM is actually coming with their own sales forecast and their own release of their EV products. So you're actually going to see Ford and GM quite literally compete head-to-head tomorrow.
Yeah, it's fascinating to see what this has to do. And when it comes to GM, we're going to hear from Mary Barra, the CEO of General Motors. She'll be talking with our own David Weston that you can hear on Bloomberg Radio and Bloomberg TV.
You can sign up for Creedy's chart of the day. You can do that at kgupta129 at bloomberg.net. Also, check out her Twitter and Instagram. Follow along at Creedy Gupta News.
Ford, by the way, one of my gainers today.
Good one.
Courtesy of you.
Well, I saw that thing surging today, and I was like, this has Carol written all over it.
It was a great one. All right, folks, let's get back to world and national news. For that, we head back to Nancy Lyons. She is in the nation's capital. Hey, Nance.
Thanks, Carol. Capitol Hill Police Chief Tom Manger says they're keeping an eye on several events scheduled for January 6th, the anniversary of the insurrection. He says there's no specific threat, but they are paying attention to a planned rally outside the Central Detention Center in Washington, where some of those linked to last year's attack are being held. He also outlined changes that have occurred in the past year to prevent another riot.
We've improved the way that we gather, analyze, share, and use and disseminate intelligence. We've brought on an operational planning expert from the United States Secret Service to develop a blueprint for handling large events with a focus on intelligence, assets, and coordination both internally and with our outside partners as well.
Manger, who was hired after January 6th, says the force is stronger and better prepared to carry out its mission. Attorney General Merrick Garland will be giving a speech tomorrow on the Justice Department's investigation into what happened a year ago. Bloomberg's Nathan Hager reports.
Up to now, Garland hasn't said much about his agency's probe into the attack on the Capitol and the events that led up to it, and he's not expected to get into specifics tomorrow. But sources tell Bloomberg the federal grand jury could lead to charges for former President Donald Trump and his allies. Those could range from criminal obstruction of Congress to conspiring to interfere in a federal election. Any decision on charges would be difficult for a Justice Department that's already being accused of being politicized. The sources say any decision on charges would be led by facts and the evidence. In Washington, I'm Nathan Hager, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take. Powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much.
It's only Tuesday, Carol.
It's only Tuesday, Lemon. I know.
It is really. It's actually Tuesday.
I had a lot of energy yesterday. Today, I don't feel like I've.
You still got it.
All right.
You're still on that vacation high.
Go.
Not vacation, but time off.
Okay. Well, Ray Dalio coming out. We've got a story by Nathan Crooks on the Bloomberg. Ray Dalio, of course, you know him well, a billionaire founder of Bridgewater Associates. He renewed his warning about holding cash and bonds today amid the ongoing pandemic-fueled increase in debt creation and monetization in the U.S. He said, this printing of money and buying of debt assets has driven interest rates so low the cash and bonds are stupid to own. He put out a post on LinkedIn. He said, I think one should consider minimizing one's ownership of cash and bonds in dollars, euros, and yen.
He said it would be a good time to borrow in those currencies, though. And remember who we're talking about, Ray Dalio, the billionaire founder of Bridgewater Investments, right?
Yeah.
Investment should be saved for stocks and inflation hedge assets in socially and financially healthy countries, he said.
Yeah, kind of interesting. He's long been known for his interest in China and its rise as a global power. He said the current economic paradigm is being driven just as much by internal conflicts over wealth and values in the U.S. that have not been seen since the 1930s. Here's what he said. There is a great internal conflict going on in the U.S. now, which makes it a risky place, he wrote. For example, it is entirely possible that neither side will accept losing the 2024 election. Whoa, where'd that come from?
Yeah, I know. Hey, I'm just looking up a story yesterday from Eric Schatzker. It talked about
the changes.
Yeah, the changes that happened there, because I was interested in the returns from Bridgewater, and there's a note at the end of Eric's piece that, as a reminder, Bridgewater also has questions being raised about the annualized returns that they've seen.
They've struggled as of late.
Yeah, so since the beginning of 2012, the firm's Pure Alpha 2 flagship fund has posted an annualized return of just 1.6%, and a few pension fund clients have withdrawn money or put Bridgewater on watch as a result.
So we put that out there, use that as will, but I always like to check performance guidance longer term, right?
Yeah.
To see when someone makes bold statements, how they've been doing. So anyway, if you want to read the whole story, do check it out at Bloomberg.com.
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. A rout in tech shares, dragging stocks from records on concerns higher interest rates will devalue their profits. Right now, we have got the S&P 500 index up 6 points. That is a gain of 0.1%. The Dow Jones Industrial Average holding on to a gain of 292 points, up 0.8%, on track for a record close. NASDAQ has plunged 188 points, a drop right now of 1.2% for the NASDAQ Composite Index. The NASDAQ 100 Index also lower by 1.2%. 10-year yield, 1.65%. We've got spot gold up 0.7%, $18.14 the ounce, while West Texas Intermediate crude is up 1.3%, $77.05 for a barrel of WTI. Briefly, according to Goldman Sachs, Bitcoin will continue to take market share from gold as part of a broader adoption of digital assets, making the often touted price prediction of $100,000 by advocates a possibility. This according to Goldman Sachs. Bitcoin right now, 46,353, up right now by 0.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Officials at the Federal Reserve are pondering a weighty question. What exactly is the future of money? Paper currency is on its way out. Cash was used in about 19% of U.S. consumer transactions in 2020, down from 40% in 2012. This transition surely has its advantages, but it comes with undeniable risk. One potential response would be for the Fed to issue a central bank digital currency, or CBDC. Retail CBDCs are electronic cash held by businesses and individuals in accounts at the central bank and backed, like paper currency, by the government. One way or another, the cashless society is coming. The Fed should seize this chance to shape the future of finance. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. This is not a twin. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, so just got about 10 minutes left in today's trading session. We are driving to the close. Let's bring in our guest, Lori Heinel. She's Global Chief Investment Officer over at State Street Global Advisors. They've got $3.86 trillion in assets under management, managing a lot. And she joins us on the phone from Boston. Lori, how are you? Happy New Year.
Happy New Year. Doing great. Seeing a little bit of sun finally.
Oh my gosh, right? It feels good. It's, I don't know, it's a little gray here, but interesting first couple of days of trading. 2 days does not make a trend, and yet we're bouncing off our lows here today. What's on the mind of investors right now as they try to make investment bets and maybe kind of set up their portfolio for the new year?
Well, lots of things are on investors' minds right now, but two of them are things that have been on our minds for quite a while now, COVID and the Fed. Mm-hmm. And those two things are moving in a little bit opposite directions right now because obviously we have concerns about COVID, particularly Omicron, but we're also starting to see that perhaps this version of COVID takes us to more of an endemic situation where it's less about the pandemic and more about learning to live with the virus. On the other hand, we've got a Fed that seems to have moved quite hawkish quite quickly. So those two things are likely to be what will battle it out in the first half of 2022.
Okay, so give us an idea of asset allocation, because we spent a lot of last week talking about fixed income and whether or not there actually is a role for fixed income in portfolios right now with the direction of interest rates and where they are now. Do you think there's still a role for fixed income?
Well, certainly asset allocation has not gotten any easier, and there are a couple of dynamics at play. First of all, we've had pretty lofty valuations in lots of parts of the equity markets. But as you note, given that fixed income interest rates are just so very low, even with a little bit of a backup here, fixed income is just not that attractive. So we've been trying to do a couple of things. First of all, look for other opportunities within equities where relative valuations are more attractive. So we've recently been repositioning out of U.S. more into Europe, where we think they benefit from the cyclical trade and we can get more attractive pricing. But we've also looked at fixed income places where there's a little bit better yield. So looking at credit, looking at emerging markets debt, for example, and perhaps putting a few other diversifiers in there, including commodities.
Interesting. U.S., though, versus the rest of the world, how do you see it?
Yeah, well, so for many, many years, the U.S. has been our core equity position, and we've been overweight at times pretty significantly versus the rest of the world. But we actually think 2022 is going to be a time when you want to pivot and focus a little bit more on non-U.S. assets. If you look at the rotation from kind of growth stocks into more cyclical sectors, European indices are just much more represented in those cyclical sectors, which should benefit as this recovery takes hold. So our trade is really more out of U.S., although not terribly underweight, but more into European for more high growth opportunities for investors.
So are you betting that in 2022, Europe will outperform the U.S.?
At the moment, that's the way we're positioned. And again, we think there are a couple of things that put a little bit of wind in the sails of Europe. As I mentioned, a bit more cyclical representation. So those are stocks that should outperform as we continue into the growth sector, or growth engine, if you will, as the economic growth recovers. We also think that the central bank there will be a bit more dovish, which should provide a bit more opportunity for valuation expansion. And we also think that Europe has a lot of other dimensions, notably being willing to have a bit more fiscal stimulus, which is something that has not happened in Europe really for the last decade.
How is, Lori, kind of the great decoupling that we might see among global central banks? In other words, will we see spheres of monetary influence? Not my words, but our Tom Orlik, chief economist at Bloomberg, and he's looking at this great decoupling of global central banks where we will see some raising rates, some not, or some even cutting rates. And, certainly when you look at something like China versus the U.S., you could see two giants in the global economy pursuing very different monetary strategies. What are the implications of that?
Well, first of all, I think that's spot on. Again, keep in mind that the backdrop for literally the last decade has been to try to stimulate growth. There wasn't any inflation that was of any concern to any central bankers. And so they could be much more dovish in their posture in support of markets and in support of economies. But now we're in a different place where we are starting to see inflation in some parts of the world, notably here in the U.S., where, as I mentioned earlier, the Fed's suddenly gotten a lot more concerned about that. We also have different growth factors here. So China, for example, has seen their growth rate slow pretty dramatically over the last couple of years. So it's a combination of inflationary pressures, growth trajectory, and also just, how there are other dynamics like the fiscal policy that are going to come into play here.
Hey, Lori, we talk a lot about inflation, and that certainly being a concern for many strategists going into 2022. When do you think inflation peaks?
Well, we actually think that we may have seen the worst of it.
Wow.
But that doesn't mean that we're going to go back to the 2% rates that we had enjoyed, pre-COVID. But what's likely to happen in our view is that the beginning of 2022 will still have, higher than normal inflation, but the inflation drivers will start to rotate a bit. So, for example, energy prices were a big driver of inflation in 2021 and likely will continue a little bit into 2022. But suddenly the comps on a year-over-year basis will become a lot different. On the other hand, we think that things like real estate and owner's equivalent rents are likely to tick up in the second half of 2022 as we start to see some of those rental prices continue to grind higher. So we think we may have hit the peak or very near the peak, but that doesn't mean we're going back to that sub 2% level.
Jobs and the labor market, do you think it continues to provide some optimism going forward? Just got about 20 seconds here.
Yeah, we do. We actually think that there could be a bit of an upside surprise in the consensus number of just over 400,000, and maybe more in the form of revisions versus the actual print for last month. But we do think that manufacturing will hold up well here, and the service sector, while being a little bit challenged right at the moment, is likely to be pretty resilient.
Right. We did get some optimism from the ISM manufacturing. We did see delivery times and prices improving, coming down in terms of prices, and delivery times reducing, which maybe that supply chain constraints getting better. All right, Lori, we got to run. Happy New Year, Lori Heinel. She's Global Chief Investment Officer at State Street Global Advisors. Tons of money, almost $4 trillion in assets under management, on the phone from Boston. All right, coming up next, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We're counting you down to the close on this Tuesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs, counting you down to the closing bell. And here to help take us beyond the bell, our global simulcast partners, Carol Massar and Tim Stenovic, bringing together our audiences across Bloomberg Television, Radio, and YouTube. And Carol, all day long, we've been talking about this idea of valuation, of multiples, and whether these high-flying stocks that we saw back in 2021, whether they can stand up in the face of a rising rate environment.
Yeah, and it certainly seems like investors thought, no, they cannot today, based on what you saw in the Treasury trade, especially that 10-year note, and versus what you saw in the NASDAQ. I should point out, though, all those major equity averages coming off their lows of the session, and it shows that investors, maybe as we get towards the tail end, doing some buying here at the close.
Yeah, and you do know that I like to take a longer-term view, and we talked a lot last week about the Santa Claus rally. Today is the final day of the technical definition of the Santa Claus rally, and indeed, we're seeing the S&P 500 higher by 1.5% and the Dow higher by 2.4%. It looks like over the last 7 days, the NASDAQ composite will be down by about 0.1%.
And it feels quiet in the offices, but it is not quiet when people are putting money to work. You were just saying, committed to the buying, 45% increase in volume over the last 20 days. If you look at the S&P 500, 22% higher. People are here and they're trading.
And the volatility is contributing to that, Caroline. I know that we've talked a lot about some of the key risks for this year. Inflation's been one, and it's been perhaps maybe more volatility on the horizon as well. Romaine, we go to the bond market volatility, where we really see that. Yesterday was only the 6th time in the last year you see basis point moves of more than 10 basis points or so.
Yeah, and you talk about the steepening that we've seen in the VIX curve. Definitely going to be a story here. We're getting the closing bells in New York. As always, it takes a minute for these numbers to settle, but it looks like the S&P 500 is going to finish in the red, down less than 0.1%, down by about 3 points here. It did trade above its record high ever so briefly there. The Dow Jones Industrial Average, though, 214 points higher, 36,799. That's up 0.6%, and that is a record high. Meanwhile, the NASDAQ, of course, which you've been talking about all day, the composite down about 1.3% on the day, or about 210 points, as most of not only the big cap tech companies, but really it's kind of that second tier of tech companies here that just have these multiples that are just completely just bananas, right? If you have a high multiple on a Tesla or a Microsoft, you think, okay, maybe they can catch up, but on a Workday, a Zscaler, I mean, who knows? What do you get out of that? Russell 2000 going to finish the day also lower here on the day, just fractionally down by about 0.2%, Carol.
Just makes me wonder, with Tesla down 4%, do we see then buyers come in tomorrow? I mean, I can't wait to see what tomorrow brings. The other thing I do want to point out, when you start to look at individual sectors, Taylor's going to get into it, but something like airlines, a lot of travel, leisure, hospitality, we saw some gains. Airlines overall up about 1.3% today, Taylor.
Yeah, let's do that, Carol. As we talk about some of the sectors, really energy, a big outperformer as well. It's the second best performer on a sector index. As you're talking about maybe that reopening trade, you're up about 3.7%. Financials are also up there, almost 4%. Really, some of the individual banks are taking advantage of that steeper yield curve, as we know traditionally do pretty well. Transportation, as Carol mentioned, up about 1.7%. Quickly, we just migrate to the bottom, and this is where you are seeing, again, it's just one day, but a rotation out of those long duration assets. Pretty much everything in the red is related to technology. It's hardware, equipment, technology, hardware, software. software and services, and some of the chip makers, which is interesting because we've gotten some positive comments out of AMD, for example, over at CES, but still chip makers taking a little bit of a breather today as well, Carol.
All right, Taylor, you mentioned transportation. Got to talk about cars today because we did hear from auto sales. I know you guys are on TV. We're talking with our colleagues out there in Detroit about those auto sales numbers. Ford didn't report. They report tomorrow. But what Ford did do in terms of some commentary today, because they were number one in the S&P 500, stock up 11.7% in today's trade. Ford believing...
round that up, Tim.
Yeah, I noticed that just now. That can hit, we can say 12%.
Can we?
You missed,
Yeah,
you missed a lot last week.
Oh,
Carol.
is this another quiz that you made Tim do?
We had a lot of fun, you guys.
Well,
we had a
I'm
lot
just
of
going to
fun.
say
You really
it's
missed
the
out.
highest since August of of 21. So we'll just put that out. I'll let you guys play with the rounding up. All right. So Ford Motor again up almost 12% here in today's session. Ford
General
believing.
Motors is higher too.
Do you want to know why?
Why?
Which one? Ford or GM?
GM.
All right. Well, GM's up about 7.5%. I don't know why, because for the first time since 1931, GM is not the top-selling automaker in the United States. Toyota took that place. They did come out, though, and said they talked about supply constraints, chips in particular, that maybe that's going to ease and production will get better. So that stock was up 7.5%. And Skechers, this one is for you, Romaine. You're a fan, right?
No.
No, he likes Crocs. He only wears Crocs.
Well, if you like Crocs, you should like Skechers. Skechers up about 4.5% today. Wedbush analysts raising the recommendation to outperform from neutral, writing that demand tailwinds remain strong because Romaine Bostick will be buying. No, he didn't say that. The stock was up about 21% last year. Boy, tough crowd today. What happened to you guys last week, Tim?
I don't know. Let's talk about the decliners. I got nothing good for you, Carol. Okay. Romaine did mention some of the high-flying tech companies that are not yet profitable, but even the profitable stalwarts having a tough day, dragging down the S&P 500. Chip makers like NVIDIA, one of those companies, finishing the day down by 2.8%. Got to check in on Apple, not seeing 182.86, which would be the price of the stock price when it hits $3 trillion, and it did that yesterday, but did not close at $3 trillion, down 1.3% today. Peloton. Another tough day for Peloton. It's 80% lower than it was from its January highs of last year, touching a new 52-week low today. So, yeah, not a new year, new Peloton. It's looking like Peloton of 2021, even in 2022.
Ouch. Finding other ways to work out. Meanwhile, tell you what's also on the downside, the yen, 5-year low of the yen versus the US dollar. This speaks perhaps we are not as fearful about Omicron as many might have anticipated. There's hospitalizations remaining relatively low as we see 1 million new cases on the day in the United States. Extraordinary, but we're not flying to a haven. We are instead looking at where the yields go in the US, at the dollar strength. The yen, therefore, down 0.7%. Aussie dollar catches the bid. We see metals have a good day. Let's look from the commodity-based FX pairs that do well over to the commodity spectrum, which is a sea of green. Why? Because actually the US dollar on its own, the dollar index, just calmed itself after the recent rally, and that means that you can start buying back into the likes of gold that was on the higher side. Brent crude catches a bit up 1.3%. Oil doing well as we see actually OPEC Plus. Yes, they're saying they'll boost production in February, but they're also saying they're seeing a tight market. They see demand despite the Omicron variant. So we see the oil just push that a little bit higher. Other metals, steel up 1.8%, zinc up 1.3%, as we had pretty good manufacturing data out of China, manufacturing data strong out of the US as well. And all of this paints a picture of the dollar slightly just taking a breather. We look at yields though, no breather there. Worldwide, we spike higher. Canadian 30-year up 15 basis points. The UK, the gilt there, up some 12 basis points. We are seeing overall money moving out of long-term bonds, Taylor.
And if it's an unch day on the S&P 500, can we say it is an unch on yields? Caroline, take a look, at least on the front end of the curve, you did get some stability, but really it is out on the long run, the 10s and the 30s that really catches our attention. Remember yesterday, you had a 12, 13 basis point move. That's only the 6th time in the last year that you've seen types of moves of more than 10 basis points. Today that continues though at a slower rate. You're up about 3 basis points or so, but you're finally back above 2% on that 30-year. And Carol, I know that the 10-year has been something we've been talking about because when you think about the buyers that come in when you hit a 175, I know today really only at a 165, but that's where you've we've started to hit some previous maybe resistance levels in the past and some of the relative attractiveness that I know that we've been talking about with Tina firmly front and center.
Yeah, maybe taking a bit of a breather considering what we saw yesterday and the continuation today. But, you do wonder, guys, let's talk about the economic news. We got into it at 3 p.m. a little bit, about an hour ago, in terms of some of the numbers that came out. ISM manufacturing, we're maybe seeing some easing when it comes to raw materials, when it comes to supply chain constraints in terms of the ability for companies to get stuff out there. I mean, Romaine, you talked about everybody leaving jobs.
Yeah.
How do we read it? How does the market read it? I mean, it does seem like the market's been focusing on rising rates at this point, but how do we read, or how should we be reading the economic news at this point?
I mean, look, this is kind of a mixed bag here, and there are some people that will look at this and say this is maybe part of a healthy churn, at least from a labor perspective. The idea, though, of course, this does feed in potentially to inflation. I do think you have to look a little bit under the hood. That fact that you lost, that you had so many resignations in food service, in healthcare, as well as in hotel and hospitality, I think it raises a lot of questions, too, about what's driving this. Is this people somehow emboldened in finding new jobs, or is it they're scared off because of COVID, or they're scared off because they still don't have childcare, or their schools are shut down, or maybe they're just giving up?
And also the high frequency data versus perhaps slightly backward looking, because there is this element, the ISM manufacturing data, yes, showing that some of those issues in supply chain, some of those issues in price points, just coming down that little bit. But that was the previous month. What of now? What when you look to, well, the what is it, open table, the high frequency restaurant bookings, really painful reading if you're looking at the previous week.
Today or yesterday? There's nobody in them.
No.
Yeah.
And luckily, labor shortages too, but seemingly for the meantime, no one to serve either.
Right, you do wonder, do we have to disregard some of these data points and then look ahead for, I don't know, another month or something for getting some clarity? All right, guys, we got to run. We got a lot going on, a lot more economic news coming our way tomorrow. That's going to do it for Beyond the Bell, our cross-platform coverage, our market wrap on this Tuesday. Join us again on radio, TV, and YouTube, same time, same place tomorrow.
This is Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, you are listening to Bloomberg Business Week. Why are you smiling?
Because I got a story for you that I can tell in 40 seconds.
Go.
Okay, so your comments about the labor market reminded me of something that happened to my wife yesterday. She went to go buy Patagonia to drop off something to get fixed. Patagonia is all about, fixing stuff that's old, right?
About that.
Yeah, it's great. She was there yesterday morning. She went by, it was probably 11 o'clock. There was a sign on the door that said, due to a staffing shortage, we're not opening until 1 o'clock today.
Wow.
So it's unclear if it's a staffing shortage due to Omicron or because they're having trouble getting employees, but this is real, Carol.
No, it's real, and I think what's interesting about what Romaine
airlines.
says, I do think there are people, though, who are moving to jobs where they are getting better opportunities, better working conditions, better pay. I think that some of that's going on.
At the same time that Omicron is causing workforces to be disrupted.
Right, and things shut down again. All right, lots going on. Let's get to world and national news because it's busy on that front as well. Here is Nancy Lyons.
Thanks, Carol. President Biden is acknowledging the next few weeks will be, quote, challenging in the battle against the coronavirus, but we will get through it together. The president says his administration is working to improve the availability of tests as well as Pfizer's new treatment that comes in pill form.
I'm directing my team to work with Pfizer to double our order from 10 million to 20 million treatment courses to be delivered in the months ahead. We may need even more.
Biden says manufacturing the pills is a slow chemical process, so it could take months for the order to be fulfilled. School closings are accelerating along with the Omicron variant. The number of in-person closings has tripled since December 19th as the percentage of positive tests goes up. Burbio, that tracks closings, says more than 3,200 schools are closed in this first week of January, still below last week's winter surge. The chief of the U.S. Capitol Police says security improvements have been made since last year's riot. He spoke today ahead of tomorrow's planned testimony before a Senate committee.
Chief Tom Manger, who took the job in July, said recommendations in an Inspector General's report are being addressed.
We've improved the way that we gather, analyze, and disseminate intelligence. We've done massive joint exercises. We've brought on an operational planning expert from the United States Secret Service to develop a blueprint for handling large events, and we have a singular mission in mind to improving the safety and security of this campus.
The chief said intelligence regarding events planned for Thursday's anniversary of the insurrection does not indicate any problems for his force. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Nancy Lyons.
All right, Nance. Thank you so much. Carol Masser, Tim Stenovic. Sorry, I was going to say it's only Tuesday.
Lemon. You were going to call me Lemon, weren't you?
I was going to call you Lemon.
That's okay.
Oh,
She's
my
cool.
goodness.
Let's talk a little bit about what's going on in New York City real estate.
Yeah, because we're going to talk a little bit more about real estate in just a moment. So there is a story on the Terminal by our Natalie Wong, and Morgan Stanley betting on offices in New York City.
Yeah, this is really interesting because it also comes after we've learned from other companies that have recently signed leases. So New York-based bank has signed a deal to take over space that houses the headquarters of BlackRock. That's according to people familiar with the matter. It's for Park Avenue Plaza, which is at 55 East 52nd Street. That's according to one of the people in the story. BlackRock moving west to Hudson Yards next year in 2023.
Wow, I think this is kind of interesting. Do you remember early on in the pandemic, I think it was Morgan Stanley and James Gorman, who specifically was saying that, I think, talked about not necessarily, we might not need as much real estate.
I don't remember who that was, but yes.
It was James Gorman, and saying...
That's right.
You know, that there might be more flexibility. And then it got kind of harder, I think, in terms of getting people back to the office.
Look, I also wonder what, if you're starting from scratch, and we talked last week about Facebook's foray into office space at... I believe in Midtown here, the big lease that they signed in the pandemic in the last year, and what that design looks like in order to facilitate collaboration in an environment where a pandemic is endemic, right? And in an environment where you have maybe flexible schedules, where people on teams come in 3 days a week or come in 2 days a week and work from home 3 days a week. What does that look like physically in an office?
I don't
remains to be seen.
But what I will say, though, too, and this whole idea of like sharing like workspaces in general, I don't know about you. I don't like sharing. I like my space.
All right, noted. I've taken notes.
But you do wonder.
I get the picture. I get the message.
But there are people who are like, well, I have a little space at home. I come into the office, I meet, I do what I need to do, and then I go back home.
Hold on. I have to call you out. Your desk is like covered in books. There's no space there.
Nobody wants to come to my desk. They're like, oh my God.
Our producer Paul knows what I'm talking about. He sits right there too.
He's chuckling in my ear. All right, I give up.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. A record for the Dow today, up 214 points, up 0.6%. The S&P lower, little change, slipping from yesterday's record. The S&P down 3 points, down by about 0.1%. NASDAQ tumbled 210. We had a rout in tech shares today. NASDAQ down 1.3%. The NASDAQ 100 index also lower by 1.3%. Worries over rising interest rates sparked that sell-off in tech shares. 10-year yield now 1.65%. Spot gold up 0.7%, $18.14 the ounce. West Texas Intermediate crude up 1.3%, $77.03 for a barrel of WTI. Ford stock surged to a 20-year high today after doubling of factory capacity for its battery-powered F-150 Lightning pickup. Ford shares today up by 11.7%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So there's a story on the Bloomberg. It was among our most read on the terminal today about Manhattan home sales reaching a fourth quarter record, capping a comeback year for a market that took a major hit earlier in the pandemic. I mean, we talked about a lot about the churn in real estate and like everybody leaving big cities.
You walk outside right now, you wouldn't know this.
No, it's pretty quiet.
It is pretty quiet. Let's get into it with Barbara Fox, president of Fox Residential Group. She joins us on the phone from New York City. Barbara, how are you?
I'm fine. How are you guys?
We're doing well. We're socially distant,
Great.
Continuing to stay safe.
Happy New Year.
Happy New Year. Help explain to us what exactly is going on in residential real estate, because, you know, we all saw the headlines in April of 2020 that New York City is over, but that's obviously not the case. Just how hot was Q4 of 2021?
Well, New York City is definitely back, and all the indications are incredibly positive for the coming months. You know, unlike past years, real estate buying activity remained very strong throughout the whole holiday season from Thanksgiving to the New Year. That's very unusual for our business. It usually goes very slow during that period. And many deals were being negotiated when the ball dropped on New Year's Eve. I mean, it was just a lot of activity, a very frantic market, and a really wonderful return to what we should always be like.
Barbara, talk to us about, I love when we dig deeper, who's buying, you know, U.S. versus foreign, families versus older folks maybe coming back to, like, who's buying and what are they buying?
Well, that's a great question. The sales throughout the whole pandemic period have been fueled by foreign buyers. Fueled by domestic buyers.
Okay.
And the domestic buyers are a lot of people who lived outside of New York, who wanted a residence in the city, and people who hadn't had an opportunity or the time to really think about buying in the city, had all of this time during the pandemic to sort of mull it over and decide. And all of a sudden, all this pent-up buying energy just hit the surface last year. It was a great year.
Barbara, are there still deals to be had in certain parts of the city, certain boroughs?
We deal mainly in Manhattan, so I don't like to talk about other boroughs, but from what I understand, deals are being made everywhere in the city of New York.
No, I mean, but deals to be had. It does seem like the price of real estate has bounced back so quickly.
Good buys.
Yeah.
Yeah, of course, there's still good buys. The interesting thing about the market is that the buyers create the market. And if an apartment or a residence is on the market for a long time without buyers, then you can be pretty sure that it's overpriced. And so the more buyers that are around, the hotter the market is, and the more they drive up the prices. So before the prices really start to go skyrocket like they have a few years ago, before that, people are taking advantage of this period in here right now where prices aren't back where they were at the height of the market. But they are pretty, they are moving up, and they're trying to buy before things go too high again.
So, Barbara, tell me something that, like, first of all, you deal with a lot of luxury high-end and some really lovely neighborhoods here in Manhattan. Tell us something that might surprise our audience, because Tim and I love real estate. We talk about it a lot, and it is interesting to see when everybody is running from the cities, and now we've seen people come back. What might surprise our audience based on what you're seeing? What's something surprising that you're seeing?
Well, in the Uber market, which is the very high end, it is
so 8, 9, 10 million more.
I'm talking about in excess of 10 million.
Okay,
and I'm talking about up to 50 million and even more on some occasions. But that market has absolutely taken off, and a lot of this is the new condominium market, the new buildings that are going up. They're very fancy new development buildings that are going up all over the city, and they have the most amenities and services, and they compete with each other to see who has the best stuff, and also the best apartments. And the prices are also way up there, and they're selling. I mean, when you look at these huge
who's buying those
that are being
properties?
built-
Is it financial folks, or who's buying?
Bitcoin billionaires.
I think
Bitcoin billionaires. Good point.
Yeah, there are a lot of financial people buying. There's a lot of money around right now. The stock market is good. It's just people who feel like they deserve it, I guess.
Got it. Listen, love talking this subject.
Hey, what does 2022 look like, just in the 30 seconds that we have left with you, Barbara?
Great. I am very positive about 2022. We're 4 days into the new year, and we have been busier in these past 2 days, Monday and Tuesday, than we have in a long time.
Wow.
It's just going off the charts. So
All right.
I'm delighted, and I think it's good for everybody that the market is so strong.
Well, great to catch up with you. Barbara Fox, president of Fox Residential Group, on the phone in New York City. I've got a property for you, 45th floor. It's in Hell's Kitchen, 10 bedrooms, and it looks like 10 and a half baths.
12 million?
$85 million.
Oh, okay. That's above my price range.
This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. Carol Massar along with Tim Stanovic. We're talking so much behind the scenes because we're really eager to get to our next guest. Glenn Hubbard's going to be with us, Dean Emeritus, Professor of Finance and Economics at Columbia. He's done a lot. He serves on boards. He's got a new book out, Tim.
Yeah, his new book, which is coming out soon, it's called The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. We're going to get the latest on that in economic news from him as well. In the meantime, a check of how that trading day ended up. Here's Charlie Pellet.
Decidedly mixed, Tim. We had the Dow higher, a record. S&P little change. NASDAQ dropped 210 points, slumping 1.3%. Stocks fell from a record after worries over rising interest rates sparked a sell-off in tech shares. The NASDAQ 100 index down 1.4% today. S&P down 3, little change, down less than 0.1%. But again, record for the Dow up 214, up by 0.6%. 10-year yield 1.64%. Spot gold up 0.7%. 18.14 the ounce. West Texas Intermediate crude up 1.2%. 77.01 a barrel. Well, as for the market backdrop, Lori Heinel is Global Chief Investment Officer at State Street Global Advisors. And right here on Bloomberg Business Week today, she told us investors are consumed with COVID and the Fed.
Those two things are moving in a little bit opposite directions right now because obviously we have concerns about COVID, particularly Omicron, but we're also starting to see that perhaps this version of COVID takes us to more of an endemic situation where it's less about the pandemic and more about learning to live with the virus. On the other hand, we've got a Fed that seems to have moved quite hawkish quite quickly. So those two things are likely to be what will battle it out in the first half of 2022.
Pfizer says the U.S. government has agreed to buy an additional 10 million courses of its COVID-19 pill, adding to the country's stash of virus-fighting tools. Pfizer shares today did move lower by 3.7%. Intel, the biggest maker of computer processors, has released a new set of laptop chips and more powerful graphics components for notebooks, stepping up efforts to take on rivals NVIDIA and AMD. Intel shares down 0.2%. NVIDIA tumbled 2.8%. AMD down by 3.9%. Recapping 10-year yield 1.64%. S&P little change, down 3 points. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie. Well, earlier today, Fed Bank of Minneapolis President Neil Kashkari made some comments. He talks about 2 interest rate increases this year to counter risk posed by inflation. I mean, we're talking so much about what comes next in terms of our economy. And our next guest definitely talks a lot about and thinks about our economic future. He's Glenn Hubbard. He's Dean Emeritus and Professor of Finance and Economics at Columbia Business School, former chairman of the U.S. Council of Economic Advisors. That was under President George W. Bush. Serves on the boards of ADP, BlackRock, MetLife. He's done a lot, does a lot, including writing a new book. It's out later this month. It's called The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. We're so delighted to have Glenn Hubbard joining us on the phone from New York City. Dean Hubbard, nice to have you here with us. How are you? And Happy New Year.
Great, thanks. I hope you're having a good New Year so far.
So far, so good. And we want to get into your book, but we feel like it relates to so much of what we try to figure out, what comes next, what should come next. Love to just get your thoughts about today's economic environment, what you think is ahead.
Well, it's a great question. I think in 2 tracks, in the here and now, the inflation concerns, I think, are real. I think monetary policy has been behind the curve, and we've spent probably too much time on demand and not enough time on getting supply chains right and supply right. So I think that can still sort itself out, but it's definitely a worry. I worry, the sort of the theme in the book as well, that there's some slower moving things that are even more dangerous for our economy. Big positive changes in technology and globalization that leave many of us quite much better off, but make some of us worse off, and our politics and our economics are affected.
So the question is, Dean Hubbard, what are the solutions that you propose to tackle some of these big picture challenges that, by the way, are much bigger than what we think about with the Omicron variant or even getting beyond this pandemic. I mean, the genesis of this goes back to before President Trump was elected.
Oh, sure. We're thinking about decades of change that, again, have been largely positive for the American economy. We all celebrate technological advance and globalization, but for many individuals and many communities, the news has not been so positive. You know, chances are, when anyone listening to this took Econ 101, I hope they like the course, and their professor probably said something like, you know, technological advance, trade makes us better off, and then probably mumbled something because the gainers can compensate the losers. The problem is we haven't been doing that. And you asked about solutions, and I think there are big, bold things we can do to build bridges, to help people compete in the world, which would be everything from bold support for community colleges and training, support for low-wage work in the country, and most importantly, an attitude shift in Washington and in the economics profession that notices these things. It goes all the way back to what Adam Smith would have taught us, founder of economics. We really, really need to help people compete.
Well, it's interesting. First of all, music to our ears. I have a degree in economics. I went to Barnard College, worked actually at the business school. Tim has an MBA from Columbia Business School and was there when you were dean.
That's why I have to call you dean. I can't even call you dean emeritus.
So we're all in on this. You know, I do think about some of the gaps and divisions that we have in our society, certainly exacerbated by the pandemic. But, you know, innovation, embracing it, like not everybody has been able to benefit by all the disruption and innovation out there. Your ideas and what you write about in this book about bridges versus walls, how can that help more people benefit in our society and our economy?
Another great question. Here's the problem. Walls are very seductive. They're very seductive for politicians to tell people, I'm going to protect you. I'm going to protect you from trade or from immigration or from technological advance. But the flip side of a wall is I'm also protecting you from all the good things that come from all of that. The right answer to the wall isn't what economists often talk about, which is just let the market rip, the kind of laissez-faire, if you will. The right answer is building bridges. And I think if we focus on, A, preparing people to compete in the world that is and will be, and reconnect them when they fall out of the economic boat, that's important. You know, classical economists like Smith always felt that the goal of an economy is mass flourishing. It's everyone participating. That should be our moral and our economic imperative. We've got to push back on the wall.
All right, sit tight for a second, Dean Hubbard. We have to do a little bit of news, but we'll come back and continue with you. We are talking with Dr. Glenn Hubbard, Dean Emeritus, Professor of Finance and Economics, at Columbia Business School. And he's got a new book out. It is called The Wall and the Bridge, Fear and Opportunity in Disruption's Wake, really relevant to so many conversations we're having today and some of the problems and obstacles we are facing. So we'll get back to him in just a moment.
In the meantime, let's head to Washington, D.C., where Nancy Lyons is standing by for a check of the latest world and national news. Hey there, Nance.
Hey, Tim. President Biden says the Omicron variant of the coronavirus is surging, and he's urging those 35 million Americans who remain unvaccinated to finally get their shots.
You'll experience severe illness in many cases if you get COVID-19, if you're not vaccinated. Some will die, needlessly die. Unvaccinated are taking up hospital beds and crowding emergency rooms and intensive care units. That's displacing other people who need access to those hospitals.
Biden says he knows the testing situation is frustrating. He says his administration is making improvements. He's warning the next several weeks are going to be challenging. He calls the new antiviral pills a game changer and says he's pushing the manufacturers to make more of them, and quickly. The travel nightmare is easing in Virginia, where a 50-mile stretch of Interstate 95 has been closed in both directions since yesterday. Senator Tim Kaine of Virginia found himself stranded with only popcorn in his car, nothing to drink. He told CNN that Virginia transportation officials are in the hot seat on this one.
I'm sure there's going to be a lot of questions about, okay, what happened? Was it poor weather forecasting? Was it inadequate pre-treatment of roads?
Kaine says traffic is now moving again, at least on the northbound lanes. Democratic Senator Joe Manchin says he remains opposed to President Biden's roughly $2 trillion package of social and environmental issues. initiatives, rather. Manchin said today he's not currently negotiating with the White House, but he did not rule out continuing those talks. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
Thanks, Nance. Carol Masser, Tim Stanovic, right here on Bloomberg Business Week. We're talking with Dr. Glenn Hubbard, Dean Emeritus, Professor of Finance and Economics over at Columbia Business School. He's got a new book out. It is The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. Dean Hubbard, we just have about a minute and a half, and then we'll do some more news and come back some more. But, we're talking about, you do in your book about building bridges. Who best builds those bridges that we need today? Is it politicians? Is it corporate leaders? Who is it?
I think it's all of the above. Business leaders have to understand that social support for the system, meaning market capitalism, isn't a given. And business leaders need to acknowledge that and pitch in. In the book, I talk about examples like George Eastman of business leaders who built entire communities, largely for their own business, but also to help others. Government needs to begin by just noticing the problem and looking at what worked in the past, like the land-grant colleges or the GI Bill. So it's really all of the above.
Is there the political will to get that done in Washington, though?
Well, the cheap answer would be to say no, but I say yes. And the reason I say yes is we're having a sterile debate over capitalism versus socialism as opposed to solving people's problems. There is a huge opportunity for a leader, be he or she a Democrat or a Republican, to come in and say, you know what? I can make people in communities better off. That's a winner.
Yeah, and I got to say, as much as the wrangling's going on, that we are actually talking about infrastructure and not just physical, but on a lot of other levels, gives me certainly hope that we're thinking about how to build those bridges and change things for the better. We're going to come back to Dr. Glenn Hubbard. He is Dean Emeritus and Professor of Finance and Economics at Columbia Business School, former chairman of the Council of Economic Advisors. That was under President George W. Bush. He's got a new book out, very relevant to so much that's going on in this world right now. It's called The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. And I know you've got some questions you want to continue with him.
Yeah, I'm looking forward to it. Hopefully he's not looking through my transcript right now, from a few years ago.
I'm sure you did just fine. All right, you're listening to Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Treasury yields move higher. Stocks end the second trading day of the new year mixed, with the Dow at a record up 214 points today, up by about 0.6%. The S&P 500 index little change but lower, retreating from a record, down 3 points, down less than 0.1%. The Nasdaq Composite Index, though, tumbled 210 points today, down 1.3%. Nasdaq 100 Index down 1.35%. Stocks slipped after worries over rising interest rates sparked a sell-off in tech shares. Today, gold up 0.8%, $18.14 the ounce. West Texas Intermediate crude up 1.4%, $77.13 a barrel. Briefly, Macy's cutting its U.S. store hours for the rest of this month as the department store chain struggles to staff locations in the post-holiday season. And the National Retail Federation plans to host more than 20,000 people in person at its annual convention in New York City next week, despite a surge in COVID cases. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Let's get right back to Dr. Glenn Hubbard, Dean Emeritus and Professor of Finance and Economics at Columbia Business School, also former chairman of the Council of Economic Advisors under President George W. Bush. He joins us once again on the phone from New York City. His new book that comes out later this month is called The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. Dean Hubbard, good to have you back with us. In the first chapter, you write about a standing room only event at Columbia Business School just 5 days ahead of the election of 2016. I was actually in that room back in 2016. You did that event with Professor Ray Horton, who was teaching modern political economy for years. I was in that class also. And this was all at a time when I think a lot of people in hindsight would say that President Trump, 5 days later, really surprised a lot of Americans by being elected. I'm wondering, though, because you write that you kind of saw this coming, and a lot of people kind of saw this coming in the way that a whole portion of the American population was disenfranchised due to globalization. What is the way for us to move forward from that? What is the way to re-enfranchise those people?
It's an excellent question. I think the issue is to notice the problem. You know, I can't claim to have predicted President Trump's electoral success, but I do think the slow-moving disenfranchisement of many Americans and communities had slipped off the radar screen of many business leaders, many politicians, and dare I say it, even many economists. You know, there's a famous question the Queen of England asked the London School of Economics about the financial crisis. Why did nobody see it coming? And you might ask the same question here. So I do think we need a new attitude among economists and in Washington to notice, to push, and to come up with real solutions.
How has the pandemic, you were already writing this book and you note that, and then the pandemic hit. How has that impacted your thinking and your writing?
Well, the pandemic, of course, makes it clear that there's not one single labor market. There are some individuals who use technology to work at home. There are many Americans for whom that's not a real possibility. And not just the pandemic today, but the future, from artificial intelligence and machine learning to the adaptation of the economy to fight climate change. These are all things that suggest really big structural shifts about to happen, and we really need to get ahead of them in a way we didn't get ahead of earlier technological changes or globalization.
You know, we talk a lot about incentives, and we talk about market incentives. We learn a lot about incentives in business school, and I'm wondering what the incentives are for policymakers to actually make these types of changes, because I think many people could argue that a lot of them look short-term, right? 2 years, an election cycle, 6 years perhaps, or 4 years for presidents. What are the incentives here for policymakers?
Well, I think many policymakers think this is all just too hard to do. It's easier just to throw out words like, let's build a wall. The problem with that is it's not too hard to do. In the middle of the Civil War, Abraham Lincoln launched the land-grant colleges, the Homestead Act, the Transcontinental Railroad. I think that was a pretty tough time for decision-making. As World War II was coming to a close, we certainly did the GI Bill for welcoming service people coming home. So we can do this. I think a politician who figures out that these sort of structural fixes actually help a lot of people probably finds political gold, not just economic gold.
You have a great line in your book. An overarching lesson for economic policy is the greater the benefits of disruption from openness, the more gainers should compensate losers, because disruption innovation, right? We certainly don't want to stop it. It has created some incredible things, but people, industry, things are impacted, people, individuals, right? And we need to not just ignore that.
Well, and to not ignore it means to notice it. You know, I comment in the book, my wife has always had this great categorization of the world into two groups, economists and real people. She always reminds me that, you know, economists tend to think about all these benefits of things, but we never really process what's happening to a lot of individuals and communities. Politicians are real people, but they need our help in noticing this.
Why do we keep ignoring and like kind of leaving behind big swaths of our society?
Well, I think things happen slowly. I don't think people intend to do it, but over time, by not noticing and taking bold action, we do. And for those who say, well, you know, we can just turn back to a standard neoliberal mindset, Milton Friedman or Friedrich Hayek, I would say I just don't think there's the social support for a market economy if we don't help people more. And that's not a radical thing to say. It goes back to Adam Smith and classical thinkers. In some sense, we got to go home again.
So what do you make of what China's doing right now? They are very much, as you know, cracking down on industries, really looking about kind of redistribution of wealth or making sure that, or trying to, it seems, have greater parts of their society, you know, enjoy some of the wealth creation that's happened. What do you make of what they're doing? Yeah.
I think it's tough in an authoritarian economy like China to do what they're trying to do. The goal shouldn't be simply to redistribute wealth. The goal ought to be to help everybody participate and flourish. Don't see much of that in what China's trying to do. And lamentably, whether it's talking about Republicans or Democrats in the United States, not a lot of that either. We do have some programs that could be modified, enhanced, beefed up to do better, but I'm not hearing that discussion in Washington or Beijing for that matter.
As the former chair of the Council of Economic Advisors under President George W. Bush, you certainly had the ear not just of the president, but also later of candidates running for president, Dean Hubbard. I'm wondering if you were advising President Biden right now, what advice you would give to him?
Focus on helping everybody participate in our economy. That's not just an economic statement. It's about dignity and flourishing. So tangibly, that means supporting work, supporting people's ability to connect to the economy. And if somebody loses his or her job from a structural change, help them get another one. I think that's a lot better. If I were to define what I would mean by Build Back Better, it would be that.
Well, certainly a lot for us to think about. We really appreciate your time, and good luck with the book. Glenn Hubbard, Dean Emeritus, Professor of Finance and Economics over at Columbia Business School. His new book out, The Wall and the Bridge, Fear and Opportunity in Disruption's Wake. It is out later this month.
All right, well, let's head to Washington, D.C. for a checkup. What is going on with Sound On with Joe Matthew? It starts in just a few minutes. Hey, Joe, what do you have on the agenda tonight?
We're actually going to be talking about a lot of these very same issues with Congresswoman Gwen Moore, a Democrat from Wisconsin. Think Milwaukee, think the Progressive Caucus, wondering what in the world happened to Build Back Better and exactly where we're going here with voting rights in this new year. We have a lot of questions, all against the backdrop of COVID, which sure keeps things complicated.
How many snowmen did you make last night?
Snow angels.
Snow angels.
Yeah, absolutely.
I hope you're
one for each of us here, three of us here in the house.
Hope you're safe and sound. All right, Sound On with Joe Matthew coming up. For the whole Bloomberg Business Week team and Tim Stanovic, I'm Carol Masser. Have a good and safe evening, everyone. This is Bloomberg Radio.